What's the difference between a money market fund account and a fixed income fund? This is a very commonly asked question, and in this video I want to explain the difference between the two. But first, let me get started with the similarities first. If you have interacted with the money market funds in any particular way, then here are some features that the two funds have in common. Number one, both the money market fund and the fixed income funds are liquid. This means that neither of the two is locked and can be accessed in case of an emergency or in case you run into a need without losing the earned interest. Because of the word fixed on the fixed income funds, many have assumed that this either gives you a fixed deposit kind of vibes where you choose a time limit or like some term which your money has to remain invested, but that's not the case. Some also thought that this fixed means that the interest that you get remains the same. For example, you get 15%, it's supposed to remain 15% all through the investment period, but that is also not the case. So your money in the fixed income funds does not come with a lock-in period, and neither do they give you a fixed return all through your investment term. They can actually be liquidated, or rather you can withdraw at any given time, and depending on the company that you're investing with or the fund manager that you're dealing with, you can access the funds instantly, or some may take up to 3 working days. So you can invest in both of these two accounts with peace of mind. The next feature is that they are both safe. None comes bearing more safety than the other, and neither comes with a promise of delivering more returns or better returns than the other. And this aligns with the next feature, which is number 3, and that is both the money market funds and the fixed income funds are regulated. You see, being part of the collective investment schemes, both of these funds are strictly regulated. Regulation helps keep you safe as the investor by giving guidelines on how the funds should be invested and to what extent. All you need to know when investing is that your company is regulated and that particular fund that you're investing in is also regulated. Always verify this through the regulator's website, and that is the Capital Markets Authority, or the CMA here in Kenya. The regulation also ensures that the fund manager does not play picky ponky with your money. Okay, you get the vibe? The next feature that is similar between the money market fund and the fixed income funds is that they both allow top-ups. Yes, you can do top-ups to each one of these two funds. This means that you're allowed to make further deposits into your account to grow your invested funds even further. Some investment options, by the way, out here don't allow top-ups into their funds once you have invested the principal, but with these two you can freely do top-ups as many times as possible and without limits of how much you should top up. And the next feature that is very similar is that they can both be used for long-term or short-term goals. You see, some people out here somewhere are looking to save for short-term goals, and the others who are looking to build their egg nest or investment over the long term. If you're either of these two, you can comfortably use any of these two accounts, either the money market fund or the fixed income funds, to achieve your goals. None has a term restriction, and therefore your goal can be achieved on either of these two. So last common feature before I tell you the differences is that they both grow on compound interest. Compound interest should be your friend, by the way, as an investor. It simply takes you further using less effort. It is a leverage to help you achieve more. You see, 5k saved for per month for 30 years, you would have saved 1.8 million. But if you put it in an interest earning 12% per year, then the money grows to 17.7 million over the same period. Can you imagine the difference? Now you can get the same experience in both the money market funds and the fixed income funds. And to this point, this brings me to the question, what then are the differences? There are two main differences to point out, but as you have already seen, most of the features are the same in these two accounts. So let me paint the picture why we have two different funds here with the same features, or like almost the same characteristics. Number one difference is where the money is invested. You see, when it comes to the money market funds, the option to invest are treasury bills, short-term bonds, fixed deposits, call and saving accounts, commercial paper, promissory notes. But what you should underline is that they are supposed to be diversified with restrictions, like not more than a certain percentage should be put in one instrument, and finally should not be put in a longer than 18 months instrument. This is to enhance liquidity and security. Then came a need for having a freedom to invest more money in the fixed income instruments such as the treasury bonds or the corporate bonds. And we all know these two mostly come with longer terms or durations that are beyond the 18-month restriction window. Also, some need to put more money into the bonds beyond the restrictions, or rather without the limits under the money market funds. And that's how the fixed income fund category was arrived at. Now, the fund manager can have the freedom to invest in funds with a longer term than the money market fund restriction of 18 months. Then next, most clients wanted to enjoy the return from the bonds, especially when the rates hit 18% plus, but still without the time restriction that comes with the bonds and the illiquidity, or the fact that you cannot withdraw your money mid-term of the tenure without losing anything. Like the bond has a tenure, you can't take away your money in between the tenure. So if I want to invest in bonds without the back and forth bidding and transferring the money and doing I don't know what, it's easy to jump on the fixed income fund and enjoy the same experience stress-free. The next difference, or difference number two, is the rate of return. These two funds have not had the same rate of return, by the way, over time. There is always one doing better than the other. Remember, one doing better than the other. Historically, long-term bonds do perform better, which tends to give better returns compared to the short-term options. But that has not been the case, by the way, over the last, I think, couple of months to the time of the publishing of this video. Money market funds have returned more than the fixed income funds, but that does not mean that they will always perform better. Underline that part. A year ago, the average of money market funds return was about 9 to 11%, while the fixed income funds were at 13 to 14% thereabout. Right now, the average for the money market funds is 15%, while the fixed income funds is at 13%. And with the dropping of the interest rate, we might get back to the point where the fixed income funds return more than the money market funds for a while. Now, where should you put your money? This is entirely up to you, by the way, but as for me, the 3% difference here and there in returns means something to my invested funds. And now, since they are both like twins, yes, they look the same, that's where being with a fund manager who offers you both options makes a whole lot of difference. And that's because all I need to do is switch my funds from a money market fund to a fixed income fund. You see, some companies migrated completely, fully from the money market funds to the fixed income funds, especially when the rates were better on this other side of the fixed income funds or the bonds. And then boom, everything changed and the money market funds went all the way up to 18% plus. But you see, as a fund manager, you can't switch back and forth. The matter you no longer do this, matter occasionally you do that. This should be your choice as a client. Investing is not a marriage where you stick for better for worse. You can move from one fund to the other, from one partner to the other, depending on the season and times. Like if my money is going to earn me 3% extra in a money market fund or a fixed income fund, I can just simply switch and move. And I enjoy watching my money grow on the dashboard. Like if you're in a ticker, you can actually attest to that, yes? And there are also several other companies which offer you these two options, and you can see that in my weekly reviews. And by choosing your most preferred company, you can actually get to enjoy both of these funds. When one is doing better, just switch, or you can split, yes? But always remember to do your homework and settle for good service. And I want to repeat, make sure you settle for good service. Hizo zingine zote zinafanana tu kabisa. Otherwise, see you in the next video.